Hello everyone and welcome back to my channel. Today we will be going over a great dividend paying growth stock. Before continuing, I would like to thank everyone so much for the likes and comments that have shown me support on my latest videos. I'm glad that you guys are enjoying my content. Here are the timestamps for the video. The stock we're covering today is Algonquin Power and Utilities Corporation, which yields a 4.49% with a payout ratio of 59.6%. They have a market cap of $10.75 billion, P/E ratio of 18.93, and a price to book of 2.52. As you can see by these numbers, Algonquin is aggressively increasing their dividend, with their most recent increase almost doubling their dividend. They are doing all of this despite still being considered a growth company. Algonquin is a renewable generation and distribution utilities company that operates mainly through its two subsidiaries, Liberty Power, mostly in Canada, and Liberty Utilities, mostly in the USA. It produces its electricity through wind, solar, hydroelectricity, and thermal facilities. It also distributes natural gas and water. This company has massive tailwinds, starting by the fact that people and governments around the world want to move away from greenhouse gas emitting power generation sources. This trend started a decade or two ago due to our concern with global warming and the destructive byproducts of power generation through oil and coal. This chart here shows the annual installations of new power sources in gigawatts in different sectors. As you can see, oil and gas are seeing a decline in investments year over year, while renewable sources like solar and wind are seeing growth year over year. This here is another interesting infographic showing which methods of renewable power generation are producing the most electricity in the USA. According to this chart, wind is taking away share from hydroelectricity, which, if you remember from last slide, Algonquin is producing 75% of its renewable energy by wind. This shows that Algonquin has been picking the correct facilities of renewable power generation that are with the current trend. Party representatives are now using climate plans to support their campaigns. This article by the New York Times talks about Joe Biden announcing a $2 trillion investment plan. More specifically, this article states that the party wishes to use this money to fund the installation of solar panels and wind turbines. Now, I do want to make two disclaimers. One, I am not affiliating myself with any political party, nor am I attempting to give an opinion on any political party. And two, political parties tend to say what the public wants to hear to gain more support. Therefore, that specific number should be taken with a grain of salt. But nevertheless, the Democrats would not be announcing such a big headline for no reason at all. It is clear that this is the direction that the general population wants the government to head towards. Algonquin is very well positioned to take advantage of these emerging renewable energy trends. And if the US or Canadian government were to start handing out bursaries and contracts to build renewable energy facilities, Algonquin would be at the forefront for this movement. Now, enough with the qualitative analysis. Let's look at some numbers for Algonquin. Over the past 5 years, pre-crash, Algonquin has delivered 121% appreciation in share value. That is 17.02% compounded annual growth rate. Post-crash, Algonquin shares have appreciated 82.4%. That is 12.77 compounded annual growth rate. Both of these figures are extremely impressive, especially considering that this is for the utility sector. Let's start looking at some of their reports. So starting with revenue, year over year, electricity distribution revenue has decreased, gas distribution revenue has increased, water distribution revenue has increased, and non-energy regulated revenue has slightly increased. This has resulted in revenue seeing only a little bit of an increase year over year for this quarter. This is actually a very good number to look at, given that we are in a current pandemic. And this demonstrates that the company's resilience during economic downturns. This is because their power purchase contracts average 14 years, and therefore revenues and cash flows do not take serious hits during downturns. On the other hand, the company saw their net income almost double year over year, which is an amazing figure to look at. Taking a look at their balance sheet, we can start by current assets, which decreased year over year. Most of that decrease came from accounts receivable. If we go over to the current liabilities side, we can also see that those numbers decreased as well. Mostly a decrease we saw in accounts payable and accrued liabilities. From these numbers, we get a current ratio of 0.62, which is not ideal. But like I said earlier, given that they have very predictable and constant cash flow from their power purchase agreements, this ratio does not scare me as much as it would for another company. Now, going back to their total assets, they have increased year over year, and looking at their total liabilities, we can see that those have increased as well. Finally, if we look at stockholders' equity or book value, we can see that overall assets have increased faster than liabilities, which brought shareholders' equity up year over year. This to me is a very important number, given that it increased during a pandemic. Looking at their cash flow statement, I'm gonna point out just a couple of specific parts I want to show from this statement, starting by the fact that year over year, cash from operating activities increased, but their net change in cash was negative. I believe that this change in cash is justifiable, as most of that cash went to property and plant investments. With all of this said, from a value investing standpoint, this company is not the prettiest, and it does not check all the boxes of a safe blue chip company. It is slightly over leveraged. It is also trading at 2 times price to book and at 18 times earning. But my counter argument for this is that Algonquin is considered a growth company. It has taken on a lot of debt to service a lot of infrastructure and development. Algonquin is, in my opinion, the best utilities company with a heavy focus on renewable energy. Not the best utilities company, but out of the ones that focus on renewable energy, it is definitely the best in my opinion. Which this has undisputable upside for the near future. I would like to finish with an intrinsic value calculation done by Simply Wall Street. They have calculated what they think is the fair value for this company based on many factors, but mainly the current and projected cash flow for the company. They conclude that the fair valuation for this company is $31.93 per share. This number should obviously be taken with a grain of salt, as it is from a single source and just one formula that does not look at the overall picture. But regardless, the website has a very positive outlook for this company, stating that it is 42.7% undervalued at the current price point. I have decided to start a position in this company very recently, because I do believe in our future being fueled by renewable energies. And I thought that Algonquin was the best play for this trend. It is more of a risky position, and in my next video I will cover utility stock that I consider to be much more stable and safe, to outweigh the slight risk that I am taking with Algonquin. With all this said, here's my position. I own 23 shares at an average price of $18.07. That is the end of the video. I will thank you all very much for watching, and I will see you in our next video.